Good afternoon. Welcome to the Gatewood Wealth Solutions weekly market commentary broadcast. This is John Gatewood, and with me today is our Chief Investment Officer, Aaron Tuttle. Welcome, Aaron.
It's good to be back.
And it's good to have you back. Hey, well, this broadcast is being recorded for future use. I just want to let you know that. But the big news this week has been the recent spike in COVID cases.
Yes, that's been the news for the last couple of weeks, right?
It has been the news the last couple of weeks, and the questions are, will this lead to more lockdowns, or, are we in for a longer than expected period of social distancing? Is this going to lead to a recession or another market correction, and ultimately impact client portfolios? What information should we be trusting when we read the news, since there seem to be such divergent opinions regarding actions that need to be taken by the various states? So there's a lot of finger pointing, as you know, out there from all sides. So Aaron today is going to cover these questions and more in today's presentation. So take it away, Aaron.
Sure. So as we usually start out, we continue to see a rebound in GDP and are expecting a recovery in the industrial activity this quarter. So we continue to progress on the timeline that we originally constructed. Now, we don't need to tell our listeners about the rise in cases for the coronavirus, and it certainly caused a lot of uncertainty. I thought it'd be good to kind of just look at some of the history. So after the peak on April 24th of 36,738 new cases, it trended down until about mid-June. And on July 3rd, here recently, we hit a new record of 56,567 new cases. So this is where those headlines are coming from. So some of this increase in new cases is due to more testing. We just are testing a lot more people. We have a lot more capability. But it's certainly not all of it. States where the number of cases have increased includes Arizona, Florida, Texas, Mississippi, Nevada, South Carolina, and California. These are where the big jumps are. Now there's some tentative evidence that these are really caused by areas where they have high summer temperatures, and there's a lot of restaurants and bars where there's a lot of air conditioning, so people are indoors. And we speculated on that 2 weeks ago on our last call. It's also probably not a coincidence that the cases surged after recent social unrest, the peaceful protests and otherwise. And really, if we had more testing capacity back in April when we had that 36,000, the antibodies suggest that we actually would have had a lot more cases documented. So even though we have a peak here of 56,000, that may not actually be the highest peak of cases that we've been experiencing based on the antibody test. Now, a lot of people question on the accuracy of the antibody test and also the virus test. There's a lot of ambiguity that is in the data for sure. Let's compare the new cases and deaths. Once again, we're going to remove that time lag and adjust the y-axis so that we can better compare that ramp up. And we can see there's a quick rise both in new cases and deaths that are lockstep at the beginning. The two lines do begin to diverge in April, but the trend remains the same until really early June. So then in May, the new cases begin to flatline while the rate continues to drop, that death rate that is. And in mid-June to July, new cases explode to the upside, and during this time, we've been told that the hospitals would be overwhelmed and daily deaths would follow the new cases up, because look at how explosive that rise is, and it would just be a matter of weeks. And we're now 5 weeks into the change in trend, and the 7-day average continues to decline.
I remember we even said 2 weeks ago, the next 2 weeks are going to be critical.
What's happening? Now, we did, it's not on this slide, but we did see a sharp increase yesterday with 933 deaths. But this was after a 3-day long weekend. And if you notice, there's a little bit of a sawtooth pattern here. So usually we see 2 days of low numbers and a surge, and they tend to be on Sunday and Monday. We think there's a lag by 1 day, and then you have weekends, and then as Monday comes around, all of a sudden the reporting shows up, and it shows up on Tuesday. Having 3 low days suggests that that 933 may be just because of a longer weekend and we're getting some deaths included into the data a little late. Today will be telling on that, because if we see something in the 500, 600, 700, not near 800 or 900, then I think we could say that it was just that anomaly in the data with the holiday weekend. But this also explains why it's really good to look at that 7-day average, because there is some clumpiness to the data. In addition, the last few days have been, we've seen a downward trend in new cases. Now, once again, this is a sawtooth pattern. It's normal to see a drop off, have a lull, and then spike back up. And when we look at the cases today, it takes a little while to update these slides, so I didn't do it today. We actually have a surge that's higher than the previous day in that sawtooth. So it does look like that it's unlikely that we're hitting that downward trend in the new cases based on the historical patterns. Either way, the cases have increased and deaths from the virus have not, at least not to the same degree. Maybe we do flatten out here, which yet to be determined. This next week will also be a very important week because we're so far in and we've had a little bit of a spike here. So New York has been in the news as Governor Cuomo announces the state is entering phase 3 of the reopening. Now, if you look here, the state is clearly past the peak in their curve. And the governor, through this time, the governor has been fairly critical of President Trump, accusing him of enabling the virus. Is that criticism warranted? Now, we try to be data dependent and not let our political opinions and our affiliations really skew our data. But I want to show how the numbers can be politicized. As a percentage of death, New York has 32,228 deaths. Of the 133,445 deaths in the United States, or about 25% of the deaths in the United States have been in New York State. This is 1,660 deaths per million. Florida is at 179 and Texas is at 94 per million. Now, could this be the beginning where Texas and Florida are going to catch up to New York? I tell you, they will certainly increase because the deaths will go up. Who knows the pace? We'll see how much over the next few weeks. As a country, the U.S. has 405 deaths per million. The U.S. therefore is ranked as number 9 in the world by this ratio. If we remove New York as a separate country, it would have the worst ratio in the world at 1660. Look at the highest one up here is 1,238 in San Marino. So New York State would actually be the worst country on this ratio. Now, if we looked at the U.S. without New York, the U.S. would drop to 15th, as it would have 324 deaths per million. So Governor Cuomo appears to be playing politics, but really, who isn't playing politics with this? And is the above comparison fair? Not at all. New York has one of the highest population densities in the world with a very well-developed public transit system, both of which would cause greater difficulty in dealing with the virus. Are we playing politics and favoring one party or the other? That's not our intent. I know we're beating up on Cuomo right now, but our intent is to demonstrate the virus and the lockdowns are being used for political agendas, and this is not surprising. We are in election season. This is silly season, and we are only 117 days until the next presidential election.
Holy cow, that's less than
It's
2-3 months.
right around the corner, and it's just so odd because what has dominated the headlines? It's not been anybody on a campaign trail, normally what we see on the elections. It has been the coronavirus. So I just want to remind our listeners that we are in silly season. And the entire governmental system, really, it's just a mess. I mean, there's a pox on both of the houses. And because of that, there is a blame game that's really only going to heat up from here. Yes, the virus is real. Yes, there are cities and states trying to slow the spread, whether that's through mandated masks or lockdowns, pausing, reversing, and really, yes, both sides are playing games with the data. Also, yes, as a nation, we will survive this virus. If we run a heat map over the last 2 weeks, we see the hot spots are actually fading. Did that happen? Yes. Our goal is not to add to the hyperbole. It's to approach the data and not let our emotions and our party politics or the affiliations that we hold really take over. This chart shows hospitalizations, right here, the third item, are actually below the April peak. However, we would be guilty of playing with the numbers to not disclose a crucial footnote in this. Florida has not published their ICU data and is missing from the current count. So it would be unfair to say, well, no, we don't see this peak. It's actually below April. Whenever one of the states that's the major hotspot, if we excluded that data, right? However, the declining data was during the time when hospitals were closed. So there's probably a lot of people that need to go back into the hospital as well. So it's just an example of how much is going on in that data that you're trying to control for to find out what actually is happening.
So
it's
this
really
is
difficult.
what makes it very difficult for people to ascertain what is truth and what's not.
Yes.
Reading the media.
It's just really hard to get good data. Now, let's go straight to the source. The CEO of Houston Methodist, Memorial Hermann Health System, St. Luke's Health, and Texas Children's Hospital held a virtual news conference recently aimed at reassuring the public that the systems are ready to handle whatever may come. Dr. Mark Boom, the CEO of Houston Methodist Hospital, is quoted regarding the uptick. He says, "Just that this number is being misrepresented, and quite frankly, we're concerned that there's a level of an alarm in the community that isn't warranted right now, or unwarranted right now." Now, whatever happens over the next couple of weeks, we will continue to monitor for changes to the economy and the death rate. And we are aware of the Miami-Dade ICU hitting a record. Once again, without with limited data, when we don't have access to see what was happening before, it's really difficult to assess. We're also aware of the recent headlines for the ICUs in Arizona. By the way, whenever they're talking about 70 or 80% occupancy in the ICUs, that sounds like a very high number, but it's routinely at 70 or 80 just for like the mean, and it can go up to 90% at any given time. So there's just, like I said, there's a lot of gamemanship going on with the data. So let's get out of the coronavirus and let's get to the economy. The GDP continues to climb out of that deep hole. Last week, record job gains helped keep the growth rate positive. The Department of Labor and non-farm payrolls soared by an unexpected 4.8 million jobs. Now, this is in line with the recent job rates on the employment. We're at 11.1%. Obviously, there's still a long way to go. The increased unemployment benefits under the CARES Act is set to expire at the end of the month if it's not extended. And we still haven't figured out if that is going to matter. Is the extra benefits causing people to not go back to work, and whenever those drop off, we'll actually see another surprise with unemployment going back up? Or do we hurt people by withdrawing that because the unemployment situation is actually worse than what we could imagine, and we're taking money away from people that can't get jobs? There's a lot there, but most likely there will be some type of compromise between the Republicans and Democrats. The Republicans have advocated giving a bonus for people to go back to work to try to offset that incentive. And I think, at least on a real politics standpoint, that makes a lot of sense. You can argue about the free market fundamentalist and principled argument for that.
I don't think it's free market, but it's the way the market is today.
It is not. It is not free market. The Institute for Supply Management Index of non-manufacturing companies, so these are, think of your service industries, jumped 57.1% from 45.4%. Now, any reading over 50% is considered positive. So this is the single biggest increase since the survey was created in 1997. The general strength should continue, but remember, there may be some volatility here as some of these regions are reversing by closing bars and they're closing restaurants, or they may be pausing some reopening. So expect some volatility on this index, but it's really a good source of trying to understand what is happening in that service economy, especially the restaurant industry. The Senate is currently on planned recess. John, I've been advocating that we have these planned recesses as long as the Senate. They are returning on Friday, but they won't start working until Monday, July 20th. And according to Missouri Senator Roy Blunt, they're using this break to collect information they need to understand how to create a second coronavirus package. The Senate will be in session for 3 work weeks until August 7th. So this gives them 15 working days, if you exclude the weekends, to debate a bill before the summer recess. They get another recess in August. Now, we've heard rumors that it's going to be a big infrastructure package. And if you listen to Senator Mitch McConnell, he's saying $1 trillion, and the Democrat House is advocating a $3 trillion range. Knowing the way the politics end up, it's probably a $5 trillion package. Add it, multiply, all that. Well, let's see how accurate this scuttlebutt proves to be. The S&P 500 index has traded really in a very tight range for nearly a month, and we had mentioned that this was likely the case on a couple of calls. 29.65 has been that low point through this trading range, and Monday's high at 31.83 is the top since June 10th. We did hit almost 32.50 earlier in the month. Now the index has not closed below its 50-day moving average, so it's been above its 50-day moving average since all the way back in April 23rd. And that line is rising fast to below current levels. So we are continuing to build up to that golden cross we mentioned a couple of weeks ago here, which is a very positive indicator on where the market is going from a technical standpoint. Now the money supply, the M2 non-seasonally adjusted climbed from 61.3% growth rate last week to 62.7% in the following week. That is just unprecedented. It is spectacular growth, but it only grew by 1.4%, which is a slowdown in the acceleration. You can actually start to see that. It makes me think of the coronavirus, right? We're peaking on that. And that's because we're no longer matching new money supply that is being created to a number that was created or was growing at a pace prior to the coronavirus, so prior to the Fed acting. So now we're starting to see big number getting compared to a big number, so that's slowing that growth down on a 13-week. Well, it's easy to correct for that. We're just going to look at a 52-week money supply growth to kind of get a sense of that change, and you can see that here on the below chart. Now, know that there are many more weeks of explosive money growth ahead, and it appears that we're going to have another multi-trillion-dollar stimulus in the works. In other words, the stock market strength has plenty of money behind it, and it's going to continue that climb, or should continue that climb. I'm going to be a little bit more correct, and likely confound those bears that continue to want to short this market. So do not sell this market. And it's not to say that we can't have corrections. We can, but the Fed would just increase its monetization at this point. So bad news is good news again whenever we're looking at this. I'll go ahead and turn it over to questions and answers now.
Well, it seems that one of the main concerns, other than the coronavirus with clients this week, has been the election. People are very concerned about what's going to happen no matter who wins the election. So what do you think will happen to the market if Trump or Biden is elected? I know that we talked about this before, but have our views changed, and are there planning recommendations that we should make given either outcome?
It's still too early. I know we're 117 days out, but we haven't had a debate. I think that's going to be very telling on this. I would say that we have changed our opinion a little bit. Know that we don't know. So just as much as there's politicalization of the virus, there's politicalization of Biden as he's in his basement and trying to protect himself from the virus. And there's been accusations of cognitive decline and also speculation that there will be a very progressive person as his vice presidency. The market is going to calculate those as a probability. It's not going to worry about whether it's true or not. It's going to assess a probability. So then there's the probability that that Biden isn't able to make it through his first term, and they would then look to the vice president to see what their policies are. And if it is somebody that is very progressive or part of this a more hard left wing that has really dominated the Democratic Party over the last couple of years, then I think the market is going to handicap the return, and that we would see a pullback.
So
now,
what is it that the market will be seeing? And let's say if you have more of a progressive socialist type of candidate, so to speak.
So let's just say that.
And this is not that it's right or wrong. We're just trying to understand this from an economic standpoint, how we would prepare our client portfolios.
Right. So we would wait to see data, because our process will help to indicate when it's when the likeliness is increasing and when you should make a change based on a risk-reward trade-off, not necessarily being right, just on a risk-reward trade-off. So we'll continue to monitor that. Like I said, we're not there yet. But let's just say the tax law that the Trump administration brought in goes away, and we're looking at a forward earnings of 170 on the S&P 500. There would likely be about a 12% drop in earnings due to the tax hit. So you're looking at 150. So there's going to be, just off that, there would be a 12% correction in the earnings, and there would be a 12% correction in the market. However, let's say capital gains go up, and I know this is counterintuitive, but if you actually have higher gains on your stocks from selling them, less people will sell them. So that means the float, or the remaining stock that's trading back and forth, becomes smaller, and you still have the same amount of pool of money that's trying to get access to the stock market. So higher capital gains after a first initial sell-off tend to then stay in the market lower, and you actually would appreciate. So it's really hard to really understand exactly where that would go. If it's a surprise, just like 2016, you would see a rearrangement of the market, and you would certainly see a sell-off. That being said, whoever is in, if it's a President Biden or a President Trump, the Federal Reserve is going to be that backstop. They're going to go in there, right or wrong. There's a lot of argument to be had on whether they're doing the correct thing with monetary policy, but they would continue to monetize the issue and try to levitate the stock market. So other than some turbulence on the value of the market, if we have a very active Fed with a very loose monetary policy, I don't know how much it would really matter. And like I said, there's a lot of debate to be had on whether that's the right thing to do or not.
Yeah, I think that the fear people have is that actually no matter which candidate gets into office, they're afraid that we're going to have a large market correction for whatever their reasoning is. And that doesn't mean that they're right or wrong, but it's a fear that they have, right?
One thing that's certain, whether it's going to be this election or something else, we will have another market correction at some point, right? But more money has been lost being on the sidelines in fear of a correction than has been lost in those temporary pullbacks. And we can see that here, right? This is one of the fastest recoveries in the market that we have for the history of the market. But all the other ones also appreciate it. So it's always a temporary loss. Painful.
So thinking ahead to our clients then, what would you advise clients in terms of things that they should be considering right now in anticipation of the fact that maybe there will be a correction at some point?
There will be a correction at some point.
Within the time frame of the election. But let's just say, so what is it that you're recommending to
So we continue to look at the cash hubs, right? And make sure that we keep those at 24 months funding for those that are going to need it, that may need to take money out of their accounts for spending or for their lifestyle. And that really is the best approach, because the market will eventually recover. So having the cash and not needing to sell during those downturns is the key to dealing with that. The other thing that you have to deal with, and it's just absolutely natural, is just the feeling of loss whenever you see that. It's not easy or fun to open up those statements and see that correction. And a lot of it is just people's own emotions selling that they cause other people to sell, right? So there's always that fight or flight response, and that's just the way humans are wired.
Yeah. So you know how you mentioned before about how we just had this jump in employment, but we heard this week that United Airlines warned that it may cut half of its workforce. Brooks Brothers filed for bankruptcy, so people are losing their jobs there, and even locally here, Merritt's, a large company, laid off a large portion of the employees that had been furloughed since the coronavirus started. Won't we see an increase in unemployment from companies like these, and how do you counterbalance that with this other factor? You have certain segments of the economy where they can't even find people.
Well, that's right. So what we don't have here, and we've talked about several times, is a business downturn because of an economic cycle, where large parts of the economy need to be restructured. We need to figure out where the new growth is going to be, and then we need to figure out how much, who to hire, get them on board, get them trained, right? So this takes 18 months, 24 months to have this process. That we're not in one of those. This is more like a natural disaster. Now, that being said, we've also talked about there are industries that have had that are forever been changed. Amazon has been taking over the retail world for quite some time, and this has just accelerated that for Brooks Brothers. Not only are people not going to the brick and mortar retail establishments like they once did, but how many people are buying suits for this environment? Very few. They're working from home.
I don't have my tie or my jacket today.
Notice that we do show the bottom, so we're not in shorts. So this was just some industries that were probably ripe for shakeup. So Zoom meetings are definitely impacting business travel. So the airline industry is definitely going to be disrupted. Merritt's does a lot of planning for business outings and doing retreats for companies. And then Brooks Brothers, not only a brick and mortar, but they sell things that are more for person-to-person interaction. And then we're not having as much business travel. So I think these industries are definitely going to shed jobs. They have to, because the environment is going to be different. But unlike a normal business downturn, Amazon's hiring. There are a lot of other places. So we're going to be a little bit better. I'm not saying that there won't be noise and there won't be some unemployment on net at times, but I think we're going to be able to process and get those that labor reassigned to areas that we kind of already know are doing well. So yes, there are going to be people who lose jobs, but I think there's going to be a lot more jobs available than a typical downturn.
One of the questions that our listeners have is that they've heard speculation that the regional hotspots for the coronavirus will lead to more interruptions of the supply chain, and that those types of interruptions could even lead to a recession, just because it would impact the flow of goods and services. So can you comment on this?
Yeah, well, I mean, if we did a shutdown like April, that certainly would be the likely outcome, that we would see another pullback in the economy. Because it wasn't the virus that caused the market and the economy to slow, it was the shutdown. However, states lost an enormous amount of revenue because of sales tax and other taxes, and they're very reluctant. And some states are in really bad shape. So they're less likely to want to do that full lockdown. And those deaths have been declining. We are getting better at treating it. It is not the same as it was in April. So that's why a lot of it is about mandating masks. You can still keep the economy going if people are wearing masks. So that's been the big push, instead of looking to curve back the opening and go back to April. Yes, they're closing restaurants and bars, but these really don't disrupt the supply chain. It's definitely hard on those small businesses, but as in the type of shutdown that we had in April, we think that's unlikely. It will slow the recovery a little bit, but I think that is why so many governors, so many municipal mayors are looking to mandate masks and not really do a shutdown. And we've adapted a lot. We definitely have a better understanding on how to get around and protect ourselves within the virus.
Well, I think, one of the things that we had talked about before our broadcast today was, where do you find information about hospitalizations? Because here we have good data on deaths, right? Because those come from death certificates. We have a reasonable data on new cases because there's testing that's being done. The problem is, are we having the same increase in hospitalization? So one of the places that we looked at was the Institute for Health Metrics and Evaluation. And what that does, it both tracks and projects what hospitalization use will be based upon the projected increase in the cases of COVID. And what's interesting when we were looking at that today was that even when they have the most the worst outlook, okay, because they have a range, from best to worst. What if everybody has masks? What if you have no masks? Even on the worst case scenario, with it increasing all the way through till the end of November, we will never reach the level of hospitalization usage that we experienced back in April and March, when there are many fewer cases than right now. So how do we read into that? How does the investment committee go to analyze that data in terms of the impact that we may see in terms of trends for market movement?
Well, we do pay attention to the way the market responds. Like today, we looked at the 933 deaths, right? And the market really didn't move anywhere. And I think they're coming to the same conclusion that we did whenever you start to get into the data. So I think the big thing is just looking at how others in the market are responding to it. Because there is a lot of data out there, and there's a lot of anecdotal evidence that you can use to try to kind of test some theories on what may be happening.
Because what wasn't part of the whole reason for the lockdown was so the hospital systems would not be overwhelmed.
Yes, that was one of the original reasons. There has been some goalposts moving from.
Right, but now we have a much higher level than we were at the peak earlier, and yet we don't experience that. So what would be the reason, do you think, for that?
Well, we've come up with better treatment options. Hydroxychloroquine has been, there's been a recent study that, I know it doesn't work, it does work.
Right,
it doesn't work,
exactly,
it does work.
Right.
But
I had another one sent to me today by some authority that says that it does work.
Right, and that's the trouble of dealing in this environment. You have both sides coming with research. Take the mask, one of the most politicized components, where there's strong opinions on both sides, and you can beat each other over the head with the scientific research that backs your places. It's just hard. But what is very easy to see is that for whatever reason, the deaths continue to decline while new cases are going. Now, there's probably a multi-factor reason, right? We are testing more people. People that are coming in for their elective surgeries that they missed out on, they get tested. And a lot of times they're asymptomatic. And that testing will say, well, they're in the hospital and they have coronavirus. Well, that gets included in the new cases. They probably never would have been, they're not even in the group that would have been tested back in April. So one, you're going to be able to find a lot more cases. Also, the medicine and the approach that we're dealing with, we've gotten a lot better at that. We also know how to protect ourselves better. If you look at our behaviors going into January versus our behaviors now, there's a clear different way that we behave. We've learned some new social etiquette on that, which we can see that because of that, those that are in the higher risk groups have dropped down on those that are testing positive. It's mainly the people that are 35 and below. That's the median age. So why would that? Because they're not really at that high of a risk of that, so they haven't changed as much behavior. So I think there's a lot of reasons why we see this, and we've talked about, and this speculation on theory, but the data seems to favor it, is that over time viruses tend to become weaker as the weaker virus strain tends to reproduce itself at a faster pace. Also, for whatever reason, the R0, that transmission ratio, is far lower than it was back in February, March, where we saw a 2.4% doubling. So it was not 2.4%, 2.4 It doubled every
Done.
2.4 days.
Right,
So I'll
exactly.
eventually get it out. So there's just been a lot of changes since then.
Yeah, I think we've certainly learned a lot, and we're doing a much better job, and because when you think about it, Canada, as I said last week, 80% of the deaths were from nursing homes.
Mhm. And I
So-
believe it's 50% here in the U.S.
Yeah, it's a high number, so I mean, we really, I think, just weren't prepared for understanding what this could mean just by a little outbreak in an enclosed community like that,
Well,
how deadly that could be.
And just to show how quick it happened, and once again, there's probably a bunch of different explanations, but you think of how bad Italy fared, and you look at New York City, which also, we looked at those numbers, 16,000, or 1660 for a death
Every million, yeah.
per million. And if you looked at London, both of those cities are 9 million. New York City had 18,000 deaths at 9 million. London had 6,000 deaths. But they were also a little bit of a lag. So Italy was worse, and then New York, and then London. And you could see that for whatever reason there was change. I don't think that there was that big of a difference between each one of them. There are differences, but I bet if we were to do a multi-factor analysis, there would be a lot of things, and one of them would be just having a better understanding of how to deal with this.
Yeah. Wow, I can't wait for the time where we don't have to talk about coronavirus, and it'll be something that's just in the history books. But
Hey, they'll be talking about it in the history
It
books.
probably will be. Well, it looks like we're out of time today, Aaron, but first of all, I want to let our clients know that their second quarter performance reports have been downloaded to your client portals. So if you look in the vault, they're there and available for viewing. We will also have a special guest during one of our next market commentary broadcasts from Citizens National Bank, who will talk about what is happening with the PPP loan forgiveness program and what to expect from the banks and the SBA as these applications are beginning to roll out. Now, I want to remind our listeners too that discussions around any specific stock or mutual fund is not an endorsement to buy or sell.
Don't buy or sell.
Don't buy or sell just because Aaron said this is what we did in the past. But simply, these are simply based upon each commentator's opinion. And all investments have risks, and past performance is not indicative of future results. That being said, I want to remind our listeners that this broadcast is open to the public. And we welcome you to invite your friends, share on social media, to have them come and listen in to our perspective on the market and the economy. So thanks again for listening in to today's broadcast. As always, if you have any questions, be sure to call your lead advisor or any other member of our team. We are here for you. So long for now.